Have you ever wondered why the stock market suddenly takes a nosedive, or why your mortgage rate is going up? A lot of the time, the answer lies with one powerful institution, the central bank. Whether it's the Federal Reserve in the US, the European Central Bank, or the Bank of England, their decisions on interest rates send ripples across the entire global economy. And if you're an investor, or just someone who wants to understand their own finances better, paying attention to these decisions is absolutely crucial. So, what exactly are we talking about when we say interest rates? Think of it as the price of borrowing money. The central bank sets a key benchmark rate, often called the policy rate. This is the rate at which commercial banks can borrow money from the central bank. Why does this one rate matter so much? Because it influences every other interest rate in the economy. The rate on your savings account, the interest on your car loan, the yield on government bonds, and yes, the cost for companies to borrow money to expand their business. It all starts here. Let's break down how this works. When the economy is running hot, and there is a risk of high inflation, meaning prices for everyday goods are rising too quickly, the central bank might decide to hike or raise interest rates. This makes borrowing money more expensive. For us as consumers, it might mean holding off on buying a new house or car. For businesses, it might mean postponing a big investment in a new factory or technology. This slowdown in spending and investment helps to cool down the economy and bring inflation back under control. It's like gently tapping the brakes on a speeding car. On the other hand, if the economy is sluggish, maybe unemployment is high and businesses are struggling, the central bank can do the opposite. They can cut or lower interest rates. This makes borrowing cheaper. It encourages people and businesses to spend and invest. Mortgages become more affordable. Business loans are easier to get, and this can stimulate economic growth, like pressing the accelerator to get the economy moving again. It's a delicate balancing act, a constant push and pull to keep the economy stable. Now, let's connect this to the financial markets, which is where things get really interesting for investors. When central banks raise interest rates, it can be a headwind for the stock market. Higher rates mean companies face higher borrowing costs, which can eat into their profits. Lower profits can lead to lower stock prices. Also, safer investments like government bonds and high-yield savings accounts suddenly become more attractive. If you can get a guaranteed 5% return from a bond, you might be less willing to take the risk of investing in the stock market for a potentially similar or lower return. This shift in investor preference can cause money to flow out of stocks and into bonds, putting downward pressure on the market. Conversely, when central banks lower interest rates, it's often like a green light for the stock market. Borrowing becomes cheaper for companies, which can boost their earnings and fuel expansion. This makes their stocks look more attractive. At the same time, the returns on safer investments like bonds become less appealing. Investors looking for higher returns are then pushed towards riskier assets like stocks. This is often described as the TINA effect. There is no alternative. When savings accounts pay next to nothing, the stock market becomes one of the only places to potentially grow your wealth, driving stock prices up. So, how can you, as an individual, use this knowledge? First, follow the news. Central bank meetings are scheduled events. Financial news outlets provide extensive coverage before, during, and after these meetings. Pay attention to the language they use. Are they hawkish, meaning they're concerned about inflation and likely to raise rates? Or are they dovish, meaning they're more focused on stimulating growth and might cut rates or keep them low? The market hangs on every single word. Second, understand the concept of market expectations. Often, the market's reaction isn't about the decision itself, but about how it compares to what investors were expecting. If everyone expects a quarter-point rate hike, and that's what happens, the market might not move much because it was already priced in. But if the central bank delivers a surprise, a bigger hike than expected, or an unexpected cut, that's when you see real volatility. This is why the commentary and forward guidance that accompany the rate decision so important. The central bank's forecast for the future is what really guides investor strategy. Let's think about your own portfolio. If you anticipate a period of rising interest rates, you might consider positioning your portfolio more defensively. This could mean looking at sectors that are less sensitive to economic cycles, like healthcare or consumer staples. You might also increase your allocation to short-term bonds, which are less affected by rate changes than long-term bonds. If you expect rates to fall, you might lean more into growth-oriented sectors like technology, which tend to benefit from cheaper borrowing costs. This could also be a good time to look at investments that were previously held down by high rates. However, it's crucial to remember that timing the market is incredibly difficult, even for professionals. A diversified, long-term approach is almost always the most sensible strategy. Don't make drastic changes based on a single prediction. Instead, use this information to understand the economic environment and make informed, gradual adjustments to your strategy. For example, a rising rate environment might make your fixed-rate mortgage look pretty good in hindsight. It might also be a great time to shop around for a high-yield savings account to make your emergency fund work a little harder for you. Understanding the interest rate cycle isn't just about stocks and bonds. It's about making smarter decisions with all your money. It empowers you to understand the why behind financial headlines and to navigate the markets with more confidence. In conclusion, central banks are like the conductors of the economic orchestra. Their interest rate decisions set the tempo for everything from market stability to your personal investment returns. By understanding the simple mechanics of how rates are raised to fight inflation and lowered to stimulate growth, you can demystify the market's behavior. Following their announcements, interpreting their language, and understanding market expectations will give you a significant edge. It turns you from a passive observer into an informed participant in your own financial future. Thank you so much for watching. I hope this breakdown helps you feel more confident about navigating the financial world. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe to the channel for more content just like this. Hit that notification bell so you never miss an update. We'll see you in the next video.